$997,000. That's what we found you'd need invested in dividend shares, just to fund an ordinary, comfortable retirement in Australia without ever touching the pension or drawing down your capital. By the end, you'll have a portfolio-size number for your own lifestyle, and you'll know why the dividend-only figure is so much bigger than the official super target. We ran the 2026 ASFA numbers against real ASX dividend yields, franking credits included, and the gap surprised us. Quick note before we start, this is general information only, not personal advice. Check a licensed professional for your own situation. The dream sounds simple. Hold shares, collect the payouts, never sell a single unit. No touching super, no waiting for a pension, no drawdown spreadsheet. But how big does that portfolio actually need to be? Most dividend calculators jump straight to a random yield and a guess. We wanted the real number. We're not tax or finance professionals here, just a household writing down what we tried, what surprised us, and what we'd check again if we were starting over. Here's the cleaner way to think about it. Before picking a yield, pick a lifestyle number first. How much do you actually want to spend each year? The most cited Australian benchmark for a comfortable homeowner retirement sits around $54,840 a year for a single person. For a couple, that comfortable benchmark climbs closer to $77,000 a year. Renters need a noticeably bigger number again. Here's the rule that changes the maths. Australia has something most other countries don't: franking credits attached to many dividends. Company tax already paid can flow back to you as a credit, so the yield you actually earn is often higher than the cash number on the page. Broad Australian shares often show a cash yield around 3 to 4%. Once franking is added back in, that grossed-up figure often lifts to around 5 to 5.5%. That's a genuine edge, but it doesn't erase tax. Franking offsets what you owe. It doesn't make dividend income automatically tax-free. Plenty of overseas markets tax the same profit twice, once at the company, once again when it lands in your account. That's the genuine edge Australian investors are working with here. So here's the formula we used. Target yearly income divided by that grossed-up yield gives you the portfolio size dividends alone would need to carry. We ran that formula across 5 lifestyle tiers, from a modest single life through to a genuinely generous one. The results are worth seeing side by side. A modest single life needs around $645,000 invested. A comfortable single life needs close to $1 million. A generous lifestyle pushes past $2.5 million. The modest tier feels achievable for plenty of long-term savers. It covers the basics comfortably without much room for surprises or big trips. The comfortable tier adds real breathing room, dining out, some travel, newer things. But it roughly doubles the portfolio you need to hold. The generous tier is where most households quietly admit dividends alone won't get them there without decades of disciplined investing or another income source alongside it. For a couple aiming at that same comfortable life, the number lands closer to $1.4 million. A more indulgent target, around $100,000 a year, needs closer to $1.8 million. Those figures move if your yield assumption moves too. A more conservative 5% adds roughly 10% to every number. A more optimistic 6% shaves off around 8% if that yield is genuinely sustainable. Worth saying plainly, every one of those figures assumes you own your home outright. Renters need a materially bigger number again, since there's no mortgage-free roof sitting underneath the plan. Now, how do you actually build this portfolio? Picking individual banks, telcos, and miners directly can work, but it means accepting real concentration and dividend cut risk in a handful of names. Broad ASX ETFs plus a higher yield tilt are often simpler for beginners. One disappointing result from a single company doesn't dominate the whole household plan that way. Here's something the spreadsheets rarely mention. Most ASX companies pay twice a year, and many ETFs pay quarterly. Switching from a steady salary to that rhythm can feel surprisingly lumpy. A cash buffer, a staggered mix of payers, or simply expecting the gaps in advance turns that lumpiness from stressful into just another household routine. While you're still building toward the target, reinvesting those dividends instead of spending them usually beats taking the cash early. That's the whole point of the snowball. Flipping over to actually living off the income works best once the portfolio genuinely clears your maths test, not before and not out of impatience. Now here's the reframe that surprised us most. Most Australians actually run two systems side by side, money inside super and money outside it. Inside super, you're allowed to draw down the capital itself, plus you may get a partial pension later. You don't need the balance to last forever untouched. The official super lump sum target for a comfortable retirement sits around $630,000. The dividends-only version needs roughly 60% more than that. That gap isn't a trick, it's honest. A dividend-only plan never touches the principal, so it simply needs to be bigger from day one. We don't see this as a rival plan to super, more as a second lens on the same question. The two can sit alongside each other rather than competing for the title of the answer. So pause on this for a second. In your own household, does a plan that never touches the capital actually matter to you, or would drawing it down slowly feel just as comfortable? That answer shifts depending on your situation too. A renter chasing full independence often leans toward the bigger dividend number since there's no paid-off home cushioning things later. For households still paying off a home loan, there's a competing question. Every spare dollar can only go one place at a time. Paying down a variable mortgage right now can feel like a guaranteed return. Every dollar off the loan is a dollar of interest you'll never pay. Building a frank dividend portfolio instead offers flexibility and long-term income, but it comes with genuine price swings a mortgage repayment never has. Honestly, there's no universal winner here. If you're close to finishing the home chapter, that often comes first. If you're renting and investing deliberately, this maths maps straight onto your plan. Whether you're in a capital city or a regional town, the formula doesn't change, only your starting lifestyle number and your local cost of living do. It shifts again if you're close to retirement rather than decades out. There's less time for compounding to do the heavy lifting, so the starting balance and the yield assumption both matter more. A family with school-age kids often runs this maths alongside a shorter list of competing costs too, so the dividend target becomes one line in a bigger household plan, not the only line. Picture two households using the exact same formula. One is starting from zero. The other already holds a modest portfolio from years of steady contributions. The number doesn't change, only the distance left to travel does. That's really the whole game. Starting earlier doesn't need a bigger paycheck, it just gives the same formula more years to quietly do its work. Now for the sober part. A dividends-only plan looks tidy on a spreadsheet, but real markets don't hand out steady, guaranteed payouts. The first trap is chasing double-digit yields. A stock paying 10% or more is often flashing a warning, not a bargain. The price has usually already fallen hard. The second trap is forgetting inflation. Today's comfortable number won't buy the same comfortable life in 15 years. Quality dividend payers usually grow over time, but never guaranteed. The third trap is sequence risk. A market fall early in retirement stings far more than one later, and dividend-only purists still face real payout cuts in a recession. Nobody saves the full amount in one lump sum though. Around $1,500 a month, compounding near 8%, can build toward $900,000 in about 19 years. The fourth trap is comparing shares straight to term deposits when rates rise. Franking and growth are real advantages, but volatility and payout risk are the trade-off, not a free lunch. Yield chasing, inflation, sequence risk, and unfair comparisons, those four traps quietly break the dividend dream for households who skip the stress test. We'll be honest, the sequence risk trap caught us off guard too. It's easy to assume steady payouts until you check what actually happened to bank dividends back in 2020. So here's the check we now run before trusting any dividend plan. Could the household survive a real income drop, not just a small wobble? Picture roughly 2 in every 10 dividend dollars vanishing for 2 full years. If the plan still holds up under that picture, it's standing on solid ground. That's not meant to scare anyone off dividends. It's the same pick the smaller ceiling thinking that keeps any household plan honest, whether it's shares, property, or super. It's not hypothetical either. Several major banks paused or trimmed their dividends back in 2020, a reminder that even the steadiest-looking payers can pull back when conditions turn. Spreading the portfolio across different sectors, not just the highest yielding names, is one of the simplest ways to soften that risk without needing to predict the next downturn. So once the traps are on the table, what's the actual next move for tonight? Start tonight with 3 simple steps. First, write down your real yearly lifestyle number, not a guess, an honest one. Second, use a conservative grossed-up yield, somewhere around 5%, not the flashiest number you've seen advertised. It's tempting to plug in the highest yield you've seen quoted somewhere online. Resist it. A conservative assumption means the plan still works even if a few payouts disappoint along the way. Third, run the 2-year stress test before committing. If the plan survives a real drop, you're not just hoping, you're checking. Then compare that number honestly against your super balance and pension timeline. Many households find a mix works better than an all-or-nothing dividend plan. Fourth, check your spread across sectors, not just your total balance. A portfolio leaning entirely on 2 or 3 high-yield names carries more risk than the headline yield suggests. Picture a household already holding a modest portfolio, adding steadily each month, aiming at the comfortable single target. Running these 4 steps turns that vague dream into an actual checkable plan. None of this needs to happen overnight. Reinvesting dividends while you're still building is often smarter than living off them early. The snowball is the whole point. The goal isn't picking the yield that sounds impressive online. It's choosing the plan that actually fits your household, your timeline, and the life you're building, and that's a genuinely good place to land. If super and pension timing are still fuzzy for you, that's worth mapping out properly too. It changes how big that dividend number really needs to be. Whatever number you land on tonight, it isn't fixed forever. Check it again each year as your income, your goals, and the real yield on your portfolio shift. If this helped map your thinking, subscribe. We put out one of these guides every week.